So the first story today comes from the FT, and that's Deutsche Bank braced for severe cull as investment bank head quits. So Germany's biggest lender is poised to slash 20,000 jobs and shed 50 billion euros of assets. And the first casualty of that was their banking chief, Garth Ritchie, who resigned last Friday ahead of the restructuring that will cull these 20,000 jobs. And this could bring about the most layoffs since the 26,000 employees when Lehman Brothers failed in September 2008, which is obviously going to send a few shockwaves out. Layoffs have already begun this week in London, New York, and Tokyo, as employees were told that their jobs were going. And some staff in London were told that their passes would stop working at 11 o'clock and not come in that day.
Wow.
Yeah.
Harsh. Your passes won't work. Stay away.
It's like hire slow, fire fast to a new level, isn't it?
Yeah, it really is. This is an interesting one, isn't it?
Absolutely. So 800 people work in the share trading business in London alone. And the CEO described the job losses as painful but unavoidable to ensure Deutsche Bank's long-term success.
This isn't a giant surprise, is it? I mean, the writing's been on the wall for Deutsche for quite some time. Their share price has been sliding for quite some time. They seem to be one of those organizations that post-financial crisis just never really quite turned it around. Of the big European investment banks, you look at the likes of Barclays, by contrast, have an investment bank. Sure, it's not performing as well as their retail bank, but they've kind of turned it around and it's making a profit. The French banks, BNP Paribas, Societe Generale, they've again sort of turned it around. Deutsche Bank has really, really struggled. There's a whole bunch of stats behind this one, so indulge me for a second. They're going to cut their global workforce to 74,000 by 2022. I mean, that's still a lot of people. And the reorganization is going to cost the company 7.4 billion euros or $8.3 billion over the next 3 years. And that's also set against the context of a quarterly loss of nearly 3 billion euros. The numbers here are massive, and it's going to cost so much just to cut what they're doing. Guys, you'd almost be better starting again with this stuff. Like it seems hard to get out of where they are. But the silver lining on this one for me was a news picture in the FT. Did anybody see this? Did you see this? The Financial Times had a picture of one of the bankers in London leaving their office, holding a bag, a little tote bag.
I just said Bitcoin on it.
Yeah, just said Bitcoin on it. And I was like, oh, yeah. This does feel like a Lehman Brothers moment. And there are rumors of a financial crisis and or crash coming, or at least a bear market coming. But I think this one maybe is a little bit different. I mean, what were your thoughts when you saw this?
I think so. I think, if you're going to have that many cuts and the losses of this scale just to actually process the cuts, obviously it's gonna start triggering fears, especially when the closest parallel is 2008 and Lehman. But I think you're right. I think this one is pretty isolated to Deutsche for the fact that they just hadn't been able to kind of turn it around since those crises. And it's quite interesting. I was kind of an intern in Canary Wharf when in October 2008, and I remember there was a bunch of recruiters that had turned all of the bins in Canary Wharf into CV drop-offs. So you would have the massive Lehman building, which I think then has since kind of changed hands a few times. And it's interesting. I'm just walking through Liverpool Street. Everyone was outside having an Aperol. So yeah.
It's mad how everybody's got a fintech job now, and I guess that's the thing is 11 years since the financial crisis, things have changed quite a bit for just about everybody. There's been this whole wave of fintech really arrived, and some of the banks have been really scrapping to kind of keep up and become what they need to become in this sort of fintech age. And this sort of looks a little bit like a cautionary tale for what happens if you don't.
Well, ex-investment bankers, the types of people that fintechs are looking to hire.
I think Revolut like them, don't they?
Shots fired. Pew pew. But I guess on that basis though, you've seen the likes of some of the fintechs. There are fintechs like Revolut that have hired some investment bankers, but there's a lot of others as well. There's a really interesting one called Ticker, TICR. I don't know if you've heard of these guys, ex-Barclays guys. We covered Jar Jar on last week's show. There's a whole bunch actually ex-bankers.
May or may not be an ex-banker.
Yeah, exactly.
Thinking, how far shall I let this go before I
just get it out there.
The CEO of Trussle, one of the trendy fintechs, hipster fintechs, ex-banker, right? So this does happen. Because you've got banking on your CV doesn't mean you can't be in fintech.
I have to say, at Chip, we don't have any ex-bankers, and I think most of our team have come from sort of marketing
McKinsey.
backgrounds, product. Yeah, I mean they're all top four.
How long do you have to work for a bank to be described as an ex-banker? Because I've got a year at Lloyd's.
No, that doesn't count. It's just
when
you came out of uni, you didn't know what to do, and you sort of give it a go.
I was just poor when I came out of uni.
You had to have 18 months like me.
I agree with that. With it in the same place. I think it's certainly more tech than fin, and certainly more marketing led. And it's about customer-centric propositions, right?
Right, exactly. And especially you're building a product that is a platform and it's user-centric. It's not actually about the fin element. Certainly from Chip's perspective.
But the other argument there is, I mean, we've seen some headlines recently, and I mean, you mentioned Revolut, which to their credit, I actually think they've got their marketing and some of their product stuff in the last few weeks really, really right. The tone of what they did around Pride and the charity donation stuff has, I think, been frankly phenomenal, and credit to them. But there's kind of that whole conversation about, do you get your tech stuff right, and can you do the finances right? We've seen N26 been hauled up by BaFin. We've seen Revolut have some challenges itself with the regulator. The fact that big banks are in trouble doesn't mean that fintechs coming along means no problems with the regulators ever again. Like, you've still got to get that stuff right.
But culture is fundamental, right? What's the hangover from this going to look like for Deutsche Bank from a cultural perspective? And that's equally what fintechs are doing so great, from values, mission, purpose, all that good stuff.
And also, I want to pick Ismail on this as well, as an ex-investment banker. Is there a way to, as you think with that hat on, the investment banking world is not immune to fintech. Now, they definitely haven't had the disruption in the sense that there's no fintechs like yourselves out there snapping at their heels just yet. But I do wonder if the boutique advisory firms can start to snip off at the profitable bits as sort of MiFID II bites, as EMIR 39 has started to bite. Is that transaction banking world and also that investment banking world the next big frontier for fintech, or is that some ways off?
It's hard to put a timeline onto it, but I think certainly there's a lot of value to be generated for users and a sort of profits to be generated as well through digitizing and automating a lot of old school and cumbersome processes. And I think you mentioned boutiques there. I think boutiques will always have a place. You look at any intermediated industries like travel, for example, and a lot of it has since been disintermediated by digital players, but you're always going to have your boutique high-end sort of luxury travel agents. And I think in the advisory world, whatever the industry, in banking, let's say, you're going to have that. But I think some of the bigger guys are going to start adopting technology. I think fundamentally it's always going to be a relationship business, but I think they're going to be highly, highly leveraged. And you would hope that the value of those deals is going to be increased through technology.
So what struck me is I think both Slack and Zoom and Spotify, recently have gone for a direct listing instead of a formal IPO. There's a lot of companies now sort of going around the M&A advisory route and the IPO advisory route. Is that still needed in the same way it was? And as we face a bear market, are there going to be more Deutsche Banks out there that really struggle?
But Slack still appointed Morgan Stanley, right, to help them with their pricing.
Yeah,
they're still going to appoint bankers to help with the process. I think it's just the extent to which they do will sort of change and iterate as people see new approaches.
Great. So I think I'm going to move us on to the next story. But just before I do, I had a question. What do you think this means for the job market? There's now hundreds, maybe thousands more people coming out of Deutsche Bank and into the job market. Where do they go? And then also, what does that mean for Deutsche Bank the next time it has vacancies? Are people going to trust it?
I mean, trust is a difficult thing to get back when it's lost. I think there's a fair amount of press around this. So I think Deutsche has got some making up to do in that respect. In terms of the job market, from our perspective, we're looking to hire another 750 people in the next year. And we don't hire specific backgrounds, we hire specific people. So if people come in and they fit what we're trying to do, and they're going to fit our quite unstructured way of working sometimes, they're welcome.
I think for the right personality, working in a fintech could be liberating, and especially if you've got some knowledge that you can really bring. I wonder though, as the rest of you Would you ever hire a banker, Simon?
I certainly would consider it. I think probably one thing that
That sounds like a no.
I sort of consider it. No, I think one thing that fintechs or tech companies in general, could possibly benefit from is sort of the as you said, the more structured way of working that perhaps these people are used to. And certainly, I've seen the benefit. I've seen that perhaps we've fallen short on that in some areas, and perhaps bringing people in from bigger organisations like Deutsche could help. Could be a benefit.
What I think is interesting is we've seen banks spend billions and not get to parity with the fintechs. And the fintechs are only ever getting faster and faster in their product development. And so to spend billions to deliver what the challengers had now or 2 years ago just doesn't make any sense as a business model, because Deutsche becomes that cautionary tale for you can spend billions, but it doesn't mean you're going to succeed. So what's your alternative? What does your portfolio of alternatives need to look like? I think it's an interesting question.
I mean, we could ponder that all day, but we should move on. So the next story comes